Welcome to my YouTube channel. My name is Michael Mwansa Dioba. We're going to look at cost and management accounting topic that has to deal with preparation of cash budget. It should be understood that cash is taken to be the lifeblood of any organization. Without cash, many operations are negatively impacted. In this particular regard, we need to take care of cash and therefore manage it properly. One of the ways in which we manage cash is by deploying a technique where we are in a position to make projection of how we are going to generate cash and how we are going to apply that cash, so that we can actually determine beforehand how we can confront periods when we have cash surpluses and how we can confront periods when we have cash deficits. So today I'm going to look at a typical examination type of question that needs to be tackled by students, especially those who are facing professional accountancy exams in the field of cost and management accounting. We have this question, which is about Better Days Limited. You are asked to look at it in this manner. Consider that you are working for Better Days Limited as a management accountant of the company that produces ball bearings to mining companies operating in Zambia. Your finance director has asked you to prepare a cash budget for the second half of the year 2023 and has provided the data below. We have this projection where we have a projection for months starting from April up to December. And the projection covers items like sales, materials, wages, production, selling, distribution, and research and development. That's what we have from April through to December. We also have additional information. The first note is that we are given that cash balance on 1st July was expected to be 75,000 kwacha, and then plant and machinery is expected to be installed in August at the cost of 20,000 and will be payable on 1st September. The extension to research and development amounting 50,000 will be completed on 1st August. Further, we have under a hire purchase agreement, a 2,000 kwacha is to be paid each month. Note number 5 is telling us that the sales commission of 5% on sales is to be held within the month following actual sales. Under that, sub-notes which are indicating that the period of credit allowed by suppliers of material is 1 month, and the payment pattern for customers is 50% in the month of sale, 25% in the month following the sale, and the balance in the month following. We also are informed that there is a delay in payment of overheads, which is 1 month, and overheads include depreciation of 1,000 kwacha per month attributed to administration. Also, a delay in payment of wages is 1 month. Further, we are told that preference share dividends of 10% on capital 1 million is to be paid on 1st November. Then 10% calls on ordinary share capital of 200,000 kwacha is due on 1st July and 1st September. And dividend ordinary shares amounting to 15,000 to be paid on 1st November. We are also further advised that cash sales of 1,000 kwacha per month are expected, and where no commission is payable. Okay, so that's what we have. Taxation amounting to 60,000 to be paid in September, and proceeds of 20,000 kwacha on disposal of old machinery is expected in October. We are required to prepare a cash budget for 6 months ended 31st December 2023. Okay. So now, normally when we are preparing a cash budget, what is important is to present the solution in a most efficient manner, where it's going to take you less time, because remember, when you are answering an examination type of question, time is of essence, and it is restricted. So we need to find ways in which to present the correct solution in the most efficient manner. The best way to approach that type of a question is to come up with a template for a cash flow. Remember, in my previous presentation for cash budget part 1 and 2, I did allude to the fact that there is a template that normally is used in the presentation of cash budget. So this is the one that I'm going to use in this particular case. Here we have to start with workings, because at professional level of examination, you find that more than 50% of time should be allocated to doing the workings. In the solution, it's a question of just tapping in from the workings figures and slotting them into the final solution. So much of the work is done on the workings, which can even account for about 60% of your time. So let's start looking at the workings. We start with the first one, which is given. We look at workings relating to sales. So we come to the sales workings. I've indicated workings under working number 1 for sales. Working number 1 for sales. Let's end this one. Okay, fine. So what we have is the figures that I've collected from the first, this column of sales, April through to December, is what I've reflected in this particular workings. Working number 1. Okay. So from April through to December, you have 50,000, 60,000, 40,000, 50,000, 60, 70, 80 through to 100,000. Those are the credit sales. Then how are these credit sales going to be received? How are the debtors going to pay? What's the payment pattern? We are guided by the note. Guided by the note to say payment pattern for the customers. For the customers is 50% in the month of sale, 25% in the month following sale, and the balance in the month following. So there's 50%, 25%, again 25%. So looking at that, you can present it in this way. You have receipts. There is 50%, there is 25%, and again 25%. Okay, so 25% is in the month following sale, 50% in the month of sale. So that's how it is. So look at this one. If you had credit sales of 50,000, then 50% of 50,000, which is 25,000 kwacha, will be paid in the month itself of sale. Then the 25% will be paid in the month following sale, which is May. So in this case, we calculate 25% of 50,000, we are going to get 12,500, which is going to come in the month of May. Then the next 25% will be 25% of 50,000, which will be in the month following to May, which will be again 12,500 coming in June. So you can see how this 50,000 will be paid by the client or the customer. 25% in April, 12,500 in May, and then 12,500 in June. Then means that the customer has paid up. The same applies to 60,000. So half of it will be paid in the month of sale, that is 30,000. 25% of that will be paid in the month following the sale, that is June, then 25% in the month following, which is 15,000 again, to be paid in July. The same pattern is followed under 40, 50, 60, 70 through 200 in the like manner. Okay. Then we are told in the note to say there was a 1,000 kwacha payment or cash payment every month. So we indicate that one. So in the month of April, we expect 1,000 cash sales. In May, 1,000 cash sales. So it's 1,000 per month. So that's why I've indicated 1,000 per month under this particular row for each month. So meaning that we are able to determine how much we are going to collect in terms of sales. Okay, we are going to collect in terms of sales for all these months. Okay, so that's what we have for all these months. That's what we have. So now, when you look at that, okay, when you look at that, it means that when you look at the total receipts from credit sales and add them to the cash sales, then we're going to come up with the last row, which is total sales receipts. Total sales receipts. So since our budget is for 6 months, ending 31st December 2023, we are only bothered with July, August, September, October, November, and December. So we only bothered for these 6 months. These 6 months. So that's what is relevant for this particular calculation. So we're going to pick 51,000, 53,000, and 63,500, 73,000 through to 93,500. So that's how we're going to determine revenue, which is going to arise from sales, both from credit and cash sales. So once we get these figures, we slot it in the template. The solution, so that is under working one. So we're getting these figures from working one, from July, August, September, October, up to December. So those are the revenue from sale. So you have to indicate which workings you have used to derive these figures. In this case, we are using working number 1. Then in this particular question, we are again advised that we have proceeds from sale of old machinery. Under the note, there was where we say there was proceeds of sale from old machinery. Okay, plant machinery to be installed in August cost statement we had to sell. There was somewhere where it says sell, so that's what we're going to follow. Okay. Okay, this note here is telling us process of 20,000 kwacha on disposal of old machinery expected in October. So we slot that one in there, So we have the proceeds on sale in October, 20,000, which was expected. So that's what you said here. Then we also have expect to get income or revenue from ordinary share capital calls. There are 2 calls, one which was done in July, the other one was expected to be made in September. So that's what we have according to the note here. We have the note which is telling us that to say we have a note to that effect. Okay, here we are. 10% calls on ordinary share capital of 200,000 is due on 1st July and the 1st September. So 10% of this 200,000 will give you 20,000. Again, 10% of the same 200,000 will give you 20,000, which will be paid in July and September. So that's what we expect to receive. So we go to the template and slot in the figure. First call, 20,000 in July. Second call, 20,000 in September. So that's all we expect to receive according to the question. So we add for each month or each period to find the total cash inflow. So when you add 51,000 to 20,000, I'll get 71,000. We add 53,500 to, you have nothing here, so it still be 53,500. We add 63,500 to 20,000, we are going to expect a total in the month of September of 83,500. The same applies to October, November, and December. We simply add the items under that column to get these totals. So that forms the total cash inflow per period in this particular sense per month. Okay, we move on to look at the next one, which is plant and machinery, which was going to be installed, and we expect a payment to be made in September according to the note that is before us. A note to that effect, say plant and machinery to be installed in August at a cost of 20,000 and will be payable only 1st September. So we bring 20,000 in September. So that's why you have 20,000 under September period. Then we also have research and development. Research and development. There's a note on research and development. Okay. Here, note number 3, extension to research and development amounting to 50,000 will be completed in August. So in August, payment is done. In August, 50,000 is floated here. Then we are also given another note to say under hire purchase agreement, 2,000 is to be paid each month. So 2,000 will be paid each month. So we slot it in there. That is the 2,000 hire purchase. Every month we are paying 2,000. Then you have sales commission. Sales commission of 5% on sales. So we look at this one. Where did we get this one? We get it from working. I did look at the working number 5. So get working number 5 in this regard. Get this and working number 5. Let's look at that. Working number 5. Okay. So let me see. Okay, looks much better. That's working number 5. So after working number 5, we take it back. Take it back, we look at where we get it. Where did we get it? From working number 5. So working number 5. So there you are. You have the credit sales, you made the sale. Just want to make an adjustment so that this particular holds true. There is a point where I just want to make an adjustment. Okay. Just an adjustment to be in line with what I calculated. So cash sales are extended, so I just want to remove this one. Okay, per month. Okay, I expected cash sales of 1,000 per month. I expected. Okay, so that's what is there. Okay, per month are expected. Okay, fine. So now we look at working number 5 then. What does it give us? So we have credit sales 50,000, 60,000, 40,000, 200,000 as we saw. Then we are also advised that there was a cash sales of 1,000 per month. So total sales, both credit and cash sales per month, in this case will be, and in April, 51,000. In May, 61,000. In June, 41,000. In July, 51,000. In August, 61,000. In September, 71,000. So these are the total sales. So we are taking that for each sale made, a commission of 5% is given. Commission of 5% is given. So means that you calculate 5% of 1,000, you get 2,550. You get the total sales in May, 61,000, 5% will be 3,050. So you can get this percentage, 5% of these total sales, you obtain these commissions. But we again advise that the commissions, there's a lag of 1 month or delay of 1 month, meaning that the commission of April will be paid in May. So that's why this, you shift this one, you bring it under May. That's when the payment will be made. This one, there's a lag of 1 month, it will be paid in the next month, which is, that's why you have it in here. Equally, this 2,050 will be paid in July. The commission of 2,550 in July will be paid in August. So that's how you develop or you generate this particular commission, showing when they were paid. So we pick this and go and slot it in the template to show how we pay the commission. So starting from the working number, coming from working 5, this is what you slot in per month as commission. Okay, we go on to look at material purchases. There's a note to that effect, materials purchases. So you go to the note. Okay, it tells you that period of credit allowed to suppliers of material is 1 month. Okay, so when you do the working, come picking the figures from here. Materials figures, these are the purchases. Okay, purchases from April through to December, credit purchases. So we pick that and we process it in a working. Material purchases, this one. Okay, so we have 20,000, 30,000, 20, 30, and through to 55 as we picked it from the table there. But we are told that the payment lagged by 1 month, meaning that the purchases of April will be paid in May. That's why you have 20,000 appearing under May here as 20,000 to show when you paid that amount. Equally 30,000, there will be a lag of 1 month, it will be paid in June. Equally 20,000, there will be a lag of 1 month to be paid in May. All these will follow the same pattern because of that note. So this reflects how the payments of the credit purchases were done. So that's what we pick. Since we are looking at on the period from July to December, we pick this, and that is under working 2. We go and slot it in the template. Can slot it in the template. Which is material purchases. You can see start from 20,000, 30, 55 through to 50. So this is coming from working number 2. Then we are told of wages. Wages also lagged by 1 month. So where are the figures coming from? From this table. Wages is here. Okay, so it lags by 1 month. It means that April wages will be paid in May. May wages will be paid in June. To show that there is a working to that effect, there is a working to that effect. Okay, wages. So here you are, 5,000. Then there's a lag of 1 month, to mean that 5,000 of April will be paid in May. 5,600 of May will be paid in June, and so on and so forth. Since we are interested only from 4,000 to December, that's the figures we're going to pick to slot into there. So you can see starting from 4,000 all the way to 5,400 from July to December. They're coming from working number 3. Coming from working number 3. Okay, so that's what we have. Then we have also overheads. We have overheads. So overheads are shown here. There is a number of elements forming the overhead. There is production, administration, selling, distribution, and research and development. So what you do in this particular case, you add up for every month the overheads. So and in April, there will be total overheads amounting to that. So, and in May, there will be total overhead adding these values. Okay, in June there will be total overheads adding these values. So there's need for a working to that. So that's what you look at. Look at the overheads. The overheads. Okay, this is the overheads. So the total under we have this production, administration, selling, distribution, research and development. Now our concern is just July to August. Because there is a lag in payment of 1 month, and then it means that instead of starting from July, we have to go behind a month earlier, that is June. Because what is going to accumulate in June is going to be paid in July, our first month of interest. So we need to capture the data from June. So that's why we have started from June to capture the data. So you look at this total of these overhead elements, which is coming to 5,720 in June, coming to 5,680 in July, and coming to 6,310 in August, and so on and so forth. But remember that these overheads, we are told that they include 1,000 kwacha depreciation. Now, depreciation is a non-cash item, so it's not a cash flow item. Therefore, if we want to see the cash movement, actual cash movement, then we have to remove depreciation from the total figure of overheads. So there's 1,000 to be removed every month. So we remove 1,000 from each of these totals. So we end up with a net of depreciation figure of overheads per month. In June, 4,720. In July, 4,680. In August, 5,320, and so on and so forth. Okay, these are the net amounts, net of depreciation, net amount of overheads. But remember that we are told that there is also a lag in payment by 1 month for overhead. Means that the amount we accumulated for overheads in June will be paid in July. The amount of overheads accumulated in July will be paid in August. This pattern continues until you finish. And we are only interested to start of the figures starting from July to December. So we only pick these figures from July to December to go and slot into the outflow section of our cash budget presentation table. Okay, so we have the overheads starting for 4,720 as captured from working number 4 through to this figure here in December. Then what we have now is the next item, which is in form of normally dividends, as given here when we pay dividends. Okay, so we are given that preference shares dividends of 10% on capital is to be paid on 1st November. Okay, preference share dividend of 10% on capital. So 10% of 1 million is going to be 100,000. So it will be paid in November. Then the other side is dividend on ordinary shares is 15,000 to be paid also in November. So dividends will be paid for preference shareholders and also for ordinary shareholders. So the 10% of 1 million, which is 100, and the 15,000 as indicated here will all be paid in November. So go and slot in these dividends payments. We have dividends, 10% preference shares, 100,000 in November, and ordinary shares, 15,000. That's what we have as in payments. Then we are told that there was taxation expected to be paid in September. Taxation expected to be paid in September. Pick from this note. Taxation amounting to 60,000 to be paid in September. So we just go to September and slot in that figure. September, 60,000. So all these are the payments that are expected to be made from July to August. So the next thing we do is find out the total cash outflow. So under each month, under each period, you add the total cash flow outflow. So we find that you have total cash outflow of 32,770 in July, 93,460 in August, 129,960 in September through to December. You just add the totals for outflows. That's what you get. The next in the template is for you to decide what is the amount of net cash flow. The net cash flow is obtained by finding the difference between total cash inflow and the total cash outflow. If you check, in this particular case, we have cash inflow in July, which is 71,000 total cash inflow, and compare it with the cash outflow in July. Cash outflow in July, total cash outflow in July is 32,770. The difference between cash inflow and cash outflow is giving you 38,230. Then we are given in the note that you expect to have an opening cash balance of 75,000. So you pick it from the note. Here we are told there is opening cash balance. Cash balance on 1st July expected to be 75,000. Okay, so the beginning opening cash balance, that is 1st July, is 75,000. So you bring it into the computation. Bring in the computation. Okay, so this is 75,000, the opening balance. So what you start with plus what you gained as a net cash flow will give you the closing cash balance. So you add the net cash flow to the opening balance. In this case, it will come to 113,230. So that is what you close with in the month of July. What you close with in the month of July automatically is what you open with in the month subsequent, which in this case is August. So you have 113,230 as the opening cash balance, where you expect to have a cash deficit of 39,930, because it means that here the cash outflow is expected to be more than the cash inflow, though you are going to have a net cash flow. But since you had the health cash closing balance in last month, July, this one will going to cover up on the deficit, end up with a cash closing balance of 73,300. What you close up with in August is what you open up with in September. So this process continues. You end up having these closing balances like that, meaning that in the last 2 months you expect a shortage of cash to the tune of 29,410 in November and the 3,917 in December. So meaning that we are expecting a deficit in November and December. So since it's way ahead of us, we can start planning for how we can bridge up this gap. That's how important cash budgeting is, so that we can actually plan ahead on how to make use of cash surpluses in the coming period, and also how to deal with the cash shortages or cash deficits in the coming period. So that's how you prepare a cash budget in a typical examination type of question. So I've shown you how to do the workings. I've shown you how to come up with a template of cash budget in the previous presentation. So please go back to the previous presentation to check the template I suggested, and that's what I've applied. And then come and practice on this particular question. See that you understand it. Do it several times so that you understand the logic behind coming up with this kind of figures. Of course, cash budget will be showing you like it's a sea of figures, but really the logic is simple to follow, and the presentation will be just as simple as this. Thank you for listening. Please don't forget to subscribe to my channel to enjoy more videos in finance and accounting, and please like my videos. Until then, I plan to end here.